Good morning. This is Barry Knapp with Ironside's Macroeconomics. It's Monday morning, 7:15 Mountain Time. Ski season's getting close. Two of the mountains up here opened over the weekend. We'll see how it goes. Supposed to snow this afternoon. Our note this week was titled "The Policy Mosaic Endgame." As I'm recording this, S&Ps are up 56 handles. Treasuries are up a basis point and change across the curve. Very little action in the dollar. Bitcoin has a bid. We've got the makings of a trade truce, we suppose, and more important for what we've been recommending that hasn't been going all that well recently, we've got a regional bank merger. That is an element of our regional bank long theme. Mergers is part of the story, regulatory loosening, but mostly a steepening of the yield curve, which is one of the topics we discussed this week, preview of the Fed meeting. So the note was broken into the title of the note, a section on the broader policy mosaic and the impact on the labor market. It stemmed from some questions we received last week, including a speech we gave in Chicago, and just how our view differed from the way the administration's been positioning their outlook. We then went on to review the CPI report, and in the email associated with this video, I included our CNBC appearance on the exchange on Friday afternoon, where I went through the impact of fiscal policy on super core inflation. It's a sort of a key element. I'll come back to that in a couple of minutes. We then went on to give a little bit of a review of earnings season, although about 50% of the S&P reports this week. So that's what a big part of what this week is going to be about, including the big tech earnings on Wednesday and Thursday after the close. Previewed, as I mentioned, the FOMC report, and then added a final section that was really more questions than anything else, but it had to do with the buying of gold, selling of Bitcoin, and China's role in all this, and just some sort of speculative thoughts about all that, just as intending to be a little bit thought-provoking and in some ways entertaining, we suppose. So let's start at the top with this policy mosaic endgame. Obviously, any administration is going to put a positive spin on or shine on the way the economy is developing. But we think none of what's happening in the labor market should be or is surprising to the administration. They had to believe that reversing this tremendous population growth that we had during President Biden's effective open border policies, and then reversing that and getting self-deportations and actual deportations and turning that around was going to have a negative impact on the growth rate of employment for sure, the supply of labor, and ultimately somewhat on GDP. Government spending was intended to reduce the number of people employed by government and eventually shift them to the private sector. But we can't imagine Treasury Secretary Besson or any of the other members of the economic team didn't think there'd be a little bit of short-term pain for longer-term gain. And then tariffs undoubtedly are impacting demand, overall aggregate demand. And as companies absorb some of the costs and profit margins, it's reducing their demand for labor. So all these things would be expected. Our perspective, though, is that the bigger impact on weak labor demand is coming from monetary policy. And that's been our contention for 3 years now, that the unbalanced policy, passive unwind of their balance sheet, even though that was the primary easing mechanism, and aggressive rate hikes, really put the burden of the pressure on small banks, businesses, and that's why demand for labor has been so weak, as evidenced by 3 consecutive big negative revisions to payrolls as the birth-death model overestimated employment. And so that is the bigger issue. The good news is we appear to be on path to fixing that, including what's going to happen this week, which will be another 25 basis point cut to the policy rate. We expect another one in December, as does the markets, and then probably another one in January. That will put monetary policy in a much more balanced state, and will set a much better, a much more favorable backdrop for the small business sector going into 2026. And of course, we know we have certainty on tax policy for small businesses. We get the individual provisions of 1BBB, as we heard Joe Livornia, who's now an advisor to the administration, refer to it late last week. And of course, we have the corporate tax provisions that, as long as aggregate demand remains constant, it probably needs to pick up somewhat, we can get some improvement in capital spending plans. As an aside, something we didn't mention in the notes, we get the last couple of regional Fed surveys today and tomorrow. And so that'll be included in our note. With Philly, New York, and Kansas City having reported so far, there's no evidence of pickup in capital spending plans or plans to hire, though the order numbers looked a little better. But we'll have a more complete analysis of those surveys in this week's note when we release it on Saturday morning. So overall, the administration probably expects that we were going to have this short-term gain to get to what they would expect to be longer-term, or short-term pain to get to longer-term gains. We'll see how that unfolds. There are certainly lots of risks in big, broad restructuring of policy the way it has unfolded so far this year. In general, we would agree with less government spending, and we would certainly agree that we need to have immigration more contained. We'd like to see it grow over time on the legal side. And then, of course, trade policy. We're not going to make any normative statements about it. What happened was inevitable. This is not unlike what happened in the early part of the last century either. We just got too carried away with thinking that somehow integrating China into global supply chains was going to be a panacea for us and give us a whole bunch of big new customers. And global mercantilism has been a theme of the last 500 years. And all of what happened is somewhat inevitable, and the reaction to it was inevitable as well. So we'll just leave it at that. As far as CPI goes, the point we made on the CNBC interview, and the most important point that we observed from all of this, is if you just look at fiscal year 24 spending, government spending that is, that increased 11%, and then you look at super core inflation, at least the way we measure it, which is non-housing services inflation, it was increasing at a 5% annualized rate in September of 2024, up from 3% a year earlier. It's now round-tripped all the way back to 3% as government spending has decelerated from 11% in fiscal year 24 to 3% in fiscal year 25. Now, there's all sorts of idiosyncratic, imputed prices in those various measures, but that is clearly the component that we would expect to be most impacted by fiscal policy. Those are domestically determined, unlike global goods prices. And the fact that they accelerated in 24 when the Biden administration was spending everything they could to try and ensure his reelection, and then decelerated in the last year, is pretty damning evidence of fiscal policy's influence on inflation, a real blind spot for the Fed, and a point of contention of ours over the last couple of years. So that's one of our strongest takeaways from the inflation report. Also, goods prices, for all the teeth gnashing about tariffs creating all sorts of inflation, the last 4 months of core goods prices are a 0.2, a 0.21, a 0.28, and a 0.22. Not exactly scary stuff. So goods prices are weakening demand for services. They're not really getting passed through to consumer, and that's because the conditions are not in place like they were in 2021, a point we've made repeatedly. We had government spending growing at a 45% annualized rate in March of 2021. A year later, goods prices went from marginally negative to plus 12.5%. Services prices moved up sharply with a lag, so did housing prices. We don't have the monetary or fiscal policy conditions in place for companies to be able to pass these tariffs through, and that is the ultimate bottom line. We're so uninterested in the commentary about the inflation rate being 3% and how can the Fed be easing. We've only been below their goofy 2% target one business cycle in the last 4 decades, and that was in the 2010s, first because of deleveraging and then because of China's excess capacity and them dumping goods on the world and depressing goods prices. So it's just this, it was a target that was intended to battle their concern about being at the zero lower bound, avoiding negative interest rates. It should have never been so explicit. And we should just be thinking about this in terms of the volatility inflation, which is running on an annualized basis at 23 basis points against a median since 1947 of 58 basis points. We have stable prices. Get over it, Fed. Let's rebalance policy, bring the policy rate down to about 3, and we should be in much better shape. As far as earnings go thus far, and we'll have more to say this week, the consumer companies have been responding reasonably well, but the numbers aren't good, and margins are still under pressure. Staple sector margins are at their lowest level in the history of the GICS indexes going back to 1990. So tariffs are pressuring margins. That is the bottom line here. Financial sector didn't really respond well to earnings, but they're really strong. And with some more easing, the shape of the curve is really going to set the stage for very strong profitability for regional banks in 2026. And we'd stick with that idea. As I said, we got a pretty notable merger this morning. We've been getting a handful of them. The regulatory environment's going to get better. We're going to hear a lot more about that. Doesn't want to matter what happens in the midterms. The regulatory environment's going to be easing over the next 3 years. An ex-Fed chair is probably going to lead the charge on that front. So we wrapped up the note with our thoughts on why the Chinese have been selling Bitcoin and buying, reportedly, and buying gold, and what they may be thinking about, and even the irony of Satoshi Nakamoto being a Japanese name, and who knows, maybe it was Chinese scientists that came up with the idea in the first place as a way to alternative to US dollar hegemony. So anyway, have a look at all that and give it some thought. If you have any comments, by all means, shoot us an email. So that's it for me this week. Barry Knapp from Ironsides. Have a good week, everyone. This is going to be a really interesting week. I'm sure we'll have a big, juicy note on Saturday because there will be lots to talk about. Have a good week. Thanks, everyone.